Jake buys a rental property. Marcus puts that exact same cash into index funds. Both guys think they made the smarter choice. You and I are about to see why they're both wrong. One forgot his hours. The other missed the zeros. When we actually run these investment numbers over 20 years, the gap might make your stomach drop. Let's keep this completely fair. Jake and Marcus both saved 50 grand. They both earn 55,000 a year. Same age, same city, identical financial starting lines. The only difference is what they actually do with that 50 grand. Jake drops a 20% down payment on a 250 grand rental, a modest 3-bedroom home in a decent neighborhood. He signs a 30-year mortgage at 7% interest. His monthly payment is roughly $1,330. He scores a tenant, paying $1,800 a month. On paper, that is $470 in profit before spending a single dime. Jake feels like an absolute genius. Marcus takes the same 50 grand and dumps it into a total stock market index fund. No leverage, zero to null, no keys to hand over. He sets up an automatic transfer of $300 a month and forgets about it. His coworkers ask him what he is investing in. He just says, index funds. They nod politely and change the subject. Nobody is impressed. By day one, Jake has a house, attenant, and a cool story for dinner parties. Marcus just has a brokerage account and a confirmation email. It is not even close in terms of how it feels. But feelings and hard math are two very different beasts. For the first few years, Jake is living the real estate dream. Rent checks hit his bank account on the first of every single month. He drives past his rental property on the way to work and smiles, thinking, I own that. He claims mortgage interest and depreciation on his taxes, slicing a couple $1,000s off his tax bill every single year. He builds home equity with every single mortgage payment. He watches comparable houses in the neighborhood slowly tick up in value. Everything about this investment feels incredibly real, tangible, and smart. Meanwhile, Marcus logs into his brokerage account maybe once a quarter. He sees the number go up a bit, then down a little, then back up. In year one, his 50 grand grows to about 55,000. Year two reaches roughly 61 grand. It barely feels like anything is happening. He has no keys in his pocket, no tenant texting him, no physical asset to point at from his car, just a simple number on a screen. Jake's friends ask about the property. Marcus's friends don't ask him about anything at all. That social proof makes Jake feel like he is winning by a mile. Stick with me here. Let's check the numbers through year three. Jake collected roughly 65 grand in rent. His mortgage payments cost about 48 grand total. That leaves 17 grand in gross cash flow. Sounds great until you subtract everything else. Property taxes run about 3 grand annually. Insurance adds 1,500 more. He replaced a water heater for $1,200, fixed a leaking roof for $2,800, and swallowed 1 month of vacancy costing $1,800 in lost rent, plus $600 to clean and list. Property management, Jake does it himself to save cash. But that means angry phone calls at 10 at night, weekend showings, and booking repairs on his lunch break. After all those real costs, Jake's actual net cash flow over 3 years is maybe 3 grand. Definitely not the 17 grand that looked so good on a napkin. And that doesn't account for a single hour of his own time. Meanwhile, Marcus invested his 50 grand plus nearly 11 grand in monthly contributions. At 10% average returns, his portfolio sits around $76,000. He spent 0 hours managing it, 0 phone calls, and 0 emergencies. But Jake still has leverage working hard for him. His rental appreciated maybe 3% a year, making it worth roughly 280 grand today. His home equity, the gap between what the house is worth and his debt, has grown to roughly 60 grand. That is real. Wealth built entirely on the bank's money, that is the magic of leverage. The one advantage stock market investors cannot easily copy. The rent check is the number everyone loves talking about. It is the flashy number on every YouTube thumbnail. The number pitched at the real estate meetup, and the exact number your landlord buddy flexes at the barbecue. But between you and me, nobody talks about the bleeding that happens to that check before you keep a dime. Take vacancy. The average rental property sits empty for about 1 month every year. That is not a total disaster, but it is a full mortgage payment with absolutely zero income to cover it. Plus, when renters move out, you end up covering deep cleans, small fixes, marketing costs, and the pure hassle of finding someone new. Then there's upkeep. I always tell people to set aside 1 to 2% of the home's total value annually for standard repairs. That equals $2,500 to $5,000 annually. Some years, it's just a simple $200 faucet repair. Other times, a $7,000 AC unit breaks in August. You can't delay it because your frustrated renter is ready to pack up and walk out. Then there are major upgrades. Roofs last maybe 20 years. Furnaces last roughly 15. Water heaters, maybe 12. I remind people these unavoidable expenses always hit in massive $5,000 to $15,000 blows. If you aren't saving cash monthly to cover those hits, you aren't truly running a business. You are just hoping for luck. Now consider management. If Jake hires someone, 8 to 10% of his rent vanishes right away. That is maybe $150 monthly. If he handles it alone, he just took on an unpaid part-time gig. Both options cost you. And let's talk about the nightmare scenario we all dread: terrible renters. A renter who stops paying and drags out the eviction can easily drain 3 to 6 months of income, plus heavy lawyer bills. That one disaster can completely wipe out your whole year of profit. You won't see these hidden threats in that $470 monthly cash flow, but they always arrive 5 years in. Jake is feeling the true grind of property ownership. He is already dealing with his third renter. He bought an $8,500 roof, paid $1,400 for emergency plumbing, and ate a month of empty vacancy costs. He pushed rent up to $1,950, which helps, but his taxes and insurance climbed right alongside it. His actual cash-on-cash return, the actual profit he keeps, compared to his initial investment, is sitting near 3 to 5% after expenses. That is okay, but miles away from the 15 to 20% he bragged about at that summer barbecue. Meanwhile, Marcus is still doing absolutely nothing. His index funds grew from 50 grand to roughly 150,000 by year 7. Counting his $300 monthly deposits, he never chased hot stocks or timed the market. He literally just left his money alone to grow. Now, compound interest is taking over. The profits on his profits are creating more fresh wealth every year than his actual cash deposits. Let's look at what is really happening. Jake is building wealth, but those heavy expenses drag it down, demanding his constant focus. Marcus is riding an exponential curve, slow early on, then exploding upward. I always say compounding feels boring for 5 years, but completely mind-blowing for the next 15. A decade in, Jake's rental is valued near $350,000. He owes $166,000 on his loan. That puts his equity around 180 grand over 10 years. Once you deduct every single hidden cost, loan interest, taxes, insurance, fixes, and vacancies, plus major upgrades, Jake spent an extra $20,000 to $35,000 out of pocket past his initial deposit. Marcus's portfolio, built on steady $300 deposits and 10% yearly returns, reached roughly $180,000. He invested 50 grand upfront plus 36,000. In steady contributions, that's 86,000 total. The rest is pure passive growth. And he wasted 0 weekends unclogging messy drains. 10 years in, their net worth is shockingly similar. Jake might lead slightly thanks to bank leverage. But here is the brutal truth. Jake burned countless hours managing that rental, carried massive debt, and gambled his entire financial future on one single house in one specific neighborhood. Marcus spread his money across thousands of global companies and slept perfectly every night. Now, you and I watch their paths completely split. Fast forward 20 years. Jake's property hits about $500,000. His initial bank loan is finally paid down to zero. His total equity sits around $500,000, depending on local appreciation. He collected steady rent that whole time. But after 2 decades of endless repairs, tenant turnovers, heavy taxes, and one massive, stressful renovation, his actual cleared profit might only be 40 to 80 grand above what he originally spent out of pocket. It could be higher in a booming market, or worse, in a flat one. Meanwhile, Marcus's passive portfolio with 10% returns and $300 monthly deposits pushed his 50 grand to nearly 460,000. And his total lifetime contribution was just 122,000. That extra 300 grand is just pure compounding, no heavy debt, zéro tenant, and no 2 in the morning phone calls about burst pipes. Their total net worth looks similar, sitting right between $400,000 and $500,000. But their paths were completely different. Jake sweated for his wealth. While Marcus let time work, Jake faced high stress, concentrated risk, and tied up cash. Marcus dealt with market swings, but kept his freedom and cash flow. Here is the big game changer. If Marcus bumped up his investing by just $200, hitting $500 a month, his 20-year portfolio easily nears $600,000. That happens because putting more into stocks creates a massive multiplier effect through compound growth. In real estate, scaling up usually means buying a new property, getting another mortgage, and doubling your daily work. You and I need to be fair. If I only bashed real estate, I would just be another stock influencer. Stocks carry real dangers. People ignore. Market swings hurt. Back in 2008, the index crashed 37%. In March 2020, it plunged 34% in weeks. Imagine Marcus having $150,000 invested, watching it drop to $95,000 incredibly fast. That is real money vanishing. It makes you sick. The data proves it. Most average investors panic sell during a crash, then buy late, locking in huge losses at the absolute worst possible moment. Plus, there is zero cash flow. Index funds will not mail you a monthly rent check. Sure, dividends exist, but with a total market fund, you are getting maybe a 1.5 to 2% yield. That makes barely $200 monthly. That will never replace an actual salary. You get no leverage. Marcus used 50 grand to hold 50 grand. Jake put down 50 grand to hold a $250,000 property. That huge leverage builds wealth fast. That is exactly why physical real estate builds far more millionaires than standard stock portfolios do. Plus, stocks lack magical tax breaks like depreciation. Property owners actually write off the imaginary wear and tear on their buildings to lower their taxes. Even while the house gains real value, it is an entirely legal tax shelter. Stock market investors simply do not get that advantage. Honestly, properties win in very specific setups. If your local market has an amazing rent-to-price ratio, meaning monthly rent hits nearly 1% of the total price, the passive income numbers work perfectly for you right out of the gate. If you run it like a serious business instead of a casual side hustle, screening every single tenant, saving for major repairs, and building solid systems, your returns can totally crush standard index funds. If you try house hacking, where you live in one room and rent the rest out, you practically drop your personal living costs to zero while building equity. You just cannot do that with a basic stock portfolio. Understand 1031 exchanges. They let you completely delay capital gains taxes by rolling your profits right into a bigger building. That lets you grow property wealth tax-free in ways stock buyers simply cannot match without using restricted retirement accounts. Real estate is not a bad investment. People just heavily misunderstand it. Jake and Marcus both walked out of their choices, completely convinced they had made the smartest possible move. Jake believed property was the only solid road to riches. Meanwhile, Marcus trusted index funds to do all the heavy lifting for him. Yet neither guy actually grabbed a pen to map out the true costs in cold hard cash, in personal time, in mental stress, or in risk over 10 to 20 years. The true danger here is not property, and it is not stocks. The fatal mistake is choosing a path just because of a flashy YouTube title, a random podcast, or what your uncle preached at Thanksgiving, without running the actual numbers yourself. Now, you and I should ask, what happens if you combine them? When you buy rentals and put money in index funds together, that is an entirely different level of wealth building. The math just might blow your mind. But until then, whenever somebody swears to you that either real estate or the stock market is the ultimate winner, I'll just ask them this. Did you actually count everything? Because knowing the complete picture is truly the only thing that actually matters here.